Hello, everyone. Happy Thursday. Today on The Final Bar, I'll be talking with Marianne Bartels from Sanctuary Wealth in New York. We'll talk about some of the longer-term charts that are helping her make sense of these markets in uncertain times. We have a lot of charts to unpack. Bond markets moving, also some individual stocks showing some signs of internal weakness. Ladies and gentlemen, this is The Final Bar. Hello, everyone. Welcome to The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny and warm Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the best practices of technical analysis. The technical toolkit is really designed to help you understand what's happening by focusing on the message the markets provide back to us in the form of price and different price-derived indicators, measures of breadth and sentiment, different ways of really measuring the flow of funds. And price, I would argue, is the best indicator of any to really help you understand what's happening. This is not just how people are voting with their voices, it's how people are voting with their capital. And that is often a great indicator of bullishness versus bearishness, euphoria versus desperation, fear versus greed, all those other emotional contrasts that I think are reflected very often in the movements in the markets. Bit of a retrenchment day, a retracement day. The major average is moving a little bit to the downside. We'll talk about this as the potential for the beginning of a deeper drawdown, what that might look like, what sort of probabilities we can assign to different potential future paths. And again, I have a great guest today with Marianne Bartels joining us for the first time and sharing some long-term charts along with her. Let's get to our market recap and focus on what the markets did today. Before we go to the charts, I do want to start with a poll. We actually had a poll going at all times on our social media accounts. Make sure you subscribe to our YouTube channel. You'll get our polls there as well. We asked you the 4 worst performing S&P sectors year to date so far this year through the end of June were utilities, healthcare, energy, and financials. Which of these performs best, in your opinion, over the next 3 months? So out of those 4, 41% of you said energy, which is interesting. It's tough with each of these because all 4 of these are beaten down sectors. These are underperforming sectors that have been struggling in a major way in 2023. One of them is going to have the best outcome after this. Most of you are, I guess, the most common answer, energy. After that, kind of a two-way tie between healthcare and financials. And what's interesting is in the financial sector, you have stocks like JP Morgan sort of basing and maybe starting to break above previous highs, but not quite following through enough just yet. And a lot of banks obviously struggling quite a bit on a relative basis. Healthcare as well. You've got some really tough charts in pharmaceuticals, in biotech. It's not hard to find some rough stocks. And utilities is probably the most interesting one because it is almost a pure defensive play, right? You kind of own utilities when you don't want to own other things and you're trying to get some income. The benefit of having a high-yielding sector like utilities probably muted by the fact that rates are higher and higher. So you're getting more just from a common treasury bond than you would from utilities in a lot of ways. So which of these 4? Energy, the number one answer. I think that's an interesting play. I hesitate to say energy only because out of all the 4, that's probably the most struggling from a technical perspective, sort of rotating lower. A lot of the big energy names, Chevron, Exxon, down pretty big today. The XLE was down the most. I would probably say financials. This is a tough one. This is like the best of the worst. It's a tough one to do. I'd probably go financials. I'll have to think about that one. 3 months is a long way too. We could go through a pullback phase, a corrective phase, and then recover 3 months from now. So it's sort of interesting to think about that future path. The goal with these kind of questions, by the way, is not to be right necessarily, although that's always fun. It's more to think about these different sectors. Where would you potentially see some opportunity, and what would you need to see in each of those charts to start to be a more technically attractive position? That's what I would be most inclined to wait for. Some sort of buy signals from some of those beaten down, underperforming sectors. Let's keep going with our market recap here. Focus on what the markets did today and connect today's movements with some of the longer-term trends that we've observed. Here are the major averages today. The S&P closing lower by about 0.8%. It was a pretty rough day, and it was down a lot more earlier in the day. Had a nice sort of bounce going into the afternoon, but the damage had been done. The S&P finishing just above 4410. The NASDAQ composite down 0.8% as well. The NASDAQ 100 about the same. Mid caps and small caps both struggling as well. The S&P 600 small cap index down about 1.5%. That's your worst performer out of this group of things. The VIX pushing above 15. It's all-time highs for the last month, and that's, I say that with a great deal of sarcasm. The VIX obviously relatively low compared to the last 12 to 18 months, right? We're down in the teens, and a lot of 2022 into 2023 was, more in the 20, 30 sort of range. We're back down where we were sort of in 2021, sort of that low volatility, slow and steady incline. When I think about what sort of signs would tell me that a top is near, that a top is happening, and that a top is confirmed, pretty much any of those scenarios when I think about a market pullback involves volatility increasing, right? The market correcting on low volatility is pretty unrealistic. That's kind of that natural inverse relationship, because when people get nervous, when people panic, volatility tends to spike, doesn't tend to stay pretty low. So looking for a spike in the VIX, maybe well above current levels, would be an interesting one. It's up a full point, 1.2 points to 15.4 or so as we're going live here after the close on Thursday. Looking at some other asset classes here very quickly, interest rates overall moving higher as well, and that's an interesting development. We've been observing over the last couple months how bond prices have been relatively stable, right? The chart of the TLT or the AG has been more in a basing pattern, meaning pretty consistent sideways trend. Remember, markets can go one of three directions at any point. They can't go backwards. They can go up, they can go down, they can go sideways. That third direction is when we usually under-expect. We sort of underplay the probability of a sideways move. We sort of think binary, right? It's either going up or going down. Bonds have given you that third direction. Bonds have been sideways. Rates have been relatively stable. Now I think we're starting to see a change that. The 10-year yield back above 4%, 5-year yield almost to 4.4%. Long bond yield above 4% as well. So the whole curve sort of moving to the upside as we wrap the day here on Thursday. Bond prices, of course, going lower. The dollar index, not too much pain from yesterday, actually remaining relatively stable, down about 0.25%. Let's look at the commodity space. You can see the DBC is down about 0.25%. The same for gold. Silver prices leading the way lower, down by about 1.8%. For the most part, a lot of red here. And as I mentioned, energy, the worst performer today, leading the way down about 2.25% for the XLE to the downside. Finally, cryptocurrencies, a lot of choppiness in the crypto space, as always, but especially today. Bitcoin currently down about 0.7% from yesterday to around 30,300. Ether prices just below 1,900, down about 1.4%. You can see mixed results from the rest of these. But overall, I think when you look at the chart of Bitcoin and Ethereum, sort of this nice rally phase going into about a month ago. And then over the last couple of weeks, it's been sort of stable, not really following through to the upside. So remember, what we talk about a lot is when you hit a key resistance level, it's not just what happens leading up to that level. It's not just that you reached it. It's what happens after, right? Do we follow through? Do we show that there's additional demand beyond enough momentum to get to that level? I think with Bitcoin and Ether prices, you're not quite seeing that yet. But that would be certainly an important thing to watch. Bitcoin above 31,000, I think, is a different chart. Sort of spiked above there in the last 24 hours, but coming back down to earth here and narrowly touching 30,000 earlier in the day today. Quickly looking at sectors, technology number one, but still down. All 11 of the S&P sectors in the red today. The XLK was down the least, down about 0.3%. The same for consumer staples and real estate. Everything else down a little bit more. Energy leading the way down about 2.25% for the XLE, followed by consumer discretionary down 1.6%. Utilities down 1.2%. Let's look at a chart of the S&P 500, see how today's movement sort of fits into the big picture. And what's interesting when you look at the chart of the S&P, sort of a day like this where you see a lot of red, you see all the sectors down, you think, oh man, this is maybe the beginning of something more significant. And it certainly could be. But what you have to remember is with so many of these charts, like the S&P, like the NASDAQ, even some of the mega cap names like Amazon, Apple, Microsoft, they've had such a run and they're so far in this bullish phase that they can pull back quite a bit and arguably still be within a pretty stable uptrend. And even in some cases, you could be down 10, 15% and still be making a higher low and have this nice sort of orderly incline. And arguably that could be the most important thing that this market could do if you're bullish, is have a meaningful pullback and a chance to reset a little bit. The S&P, again, just narrowly off the highs for the year, which it set in the last couple days, sort of over the holiday weekend. today's downdraft still within the range of the last couple weeks, holding above 4,300 to 4,325. That's that pink shaded area that we've talked about. Now, this is a Fibonacci level. This really lines up with the August 2022 highs. That's why we've had this level highlighted for quite some time. We broke above there earlier in June. We pulled back to the upper end of this range and then moved to just barely make a new high going into the holiday weekend. Now we've sort of rotated back lower, but again, still above that level. That line in the sand for me remains about 4,300. As long as the S&P holds that, things are just not getting that bad. A level like that starts to break. We start to not hold a level like that, and I think that's when we can start thinking about some concerning negative developments. Speaking of which, I'm observing more and more bearish momentum divergences where the price is going higher and the momentum is not doing so. You might find that on some of the charts that we're looking at today. Earlier in the week, we highlighted other names that we're seeing that divergence, like LRCX, Lam Research, and the semiconductor group. We talked about that stock yesterday. So keep an eye on those sorts of developments. I always thought when those sorts of patterns emerge, that's often a leading indicator that conditions are starting to be a little less ideal than the price may imply on its own. You know, the NASDAQ 100, of course, continuing to push higher. You're having a similar situation like you have with the S&P. In this case, it's sort of testing the high, sort of a double top of sorts. And I'm looking at 2 years of data, so it might be a little hard to see that. But if we look at the last 6 months, you can see what I mean about this sort of little double topping pattern, right? We tested the high here just above 370 on the Qs in June, mid-June, and now here in early July, we sort of pulled back up to that level. Now, again, this is a short-term pattern. The longer-term trend's still obviously very clearly positive. We're making higher highs and higher lows. Most recent low around 357, 358 or so, higher and higher. So as long as that trend continues, as long as that pattern continues, the conditions overall are continue to be fairly strong. On my own YouTube channel called Market Misbehavior, over the last week, I've put up 2 videos. One that lays out 4 potential future paths for the NASDAQ 100, the QQQ, and then a follow-up video that I just posted yesterday, really handicapping and giving my own probabilities for those 4. So if you missed those, go to that the YouTube channel called Market Misbehavior. You can go through those and actually vote on which scenario you see as most likely and why. But that might help you think about some of the different future paths and what a pullback, which I think we're on the cusp of, what that might actually look like for your portfolio. Let's look at the interest rate environment. As I mentioned, higher rates, and we've talked about the prospect of higher rates for quite some time, but the reality is the 10-year just really hasn't been pushing that much higher, right? We've sort of been in this basing pattern going between around 3.3% up to around 4% on the upper end. And that's been the case for the last 7 or 8 months or so. This is coming off the high in October of last year when the 10-year hit around 425. What's happened in the last week is we've broken above a trend line. If you take the October high from last year, the February, really the March high from this year, line it up to where we're at. We've just broken higher above that level in the last week. And this is after coming off of the 200-day moving average here, sort of in that reddish color. So now we're actually seeing rates start to go higher. What's interesting is this is the relative performance of value over growth. It's the Russell 1000 value ETF versus the growth ETF. You can see it's actually still trending lower. That's a little counterintuitive, sort of an interesting, divergence of sorts, that rates are going higher. That tends to be a little worse for growth, but growth is actually still doing just fine. Those mega cap names still allowing that area of the market to dominate other areas of the market, more value-oriented sectors, and certainly more defensive sectors we might consider. Looking briefly at non-U.S. stocks, I know we have a number of viewers in India, and hello and good morning to all of you if you're watching this overnight for us. Just wanted to let you know, have not missed the fact that India has been in a pretty good place. If you look at the Nifty, dollar sign Nifty, this is looking at one of the key Indian benchmarks in local terms. And if you look at it in local currency terms, new highs, all-time highs, and continue to show strength. The Nifty's overbought right now. That on its own is not a bad thing. That just means we've gone up a ton. I would be concerned when we start to get more divergences. When it's overbought and all of a sudden it comes out of that region. For now, it's showing an incredible amount of strength. Now, in the U.S., we often use ETFs that are dollar denominated. So INDA is the one, that's the MSCI India ETF coming from iShares. That's the one I tend to follow more than others. What's interesting is when you look at this ETF, we're actually testing the highs from the second half of 2022. So while in local currencies we got into new highs, In US dollars, you're actually seeing resistance here in August, September, November, December, all right around the same level, sort of this $43.50 to $44 range. I'd be really optimistic if we can get above that level. But if you draw trend lines from the major highs over the last 12 months, pretty encouraging to see that development. I will tell you, we don't really have time to go through a lot of individual Indian names, but you look at a stock like Tata Motors, not a bad chart. And you don't see a lot of charts that look like this in the US. It's a reminder that as a globally minded investor, there are often pockets of opportunity in non-US markets. So, again, a lot of times that has to do with the dollar and making sure that the dollar is giving you not as much of a headwind and giving you a little more of a tailwind to non-US exposure. But I can't go past the fact that some of these individual Indian names showing a lot of strength, and again, the local benchmarks moving higher as well. Back in the US, semiconductors are an important space to watch. This is one of those bellwether groups that I think is always important to pay attention to. This is the SMH. What's interesting is if you look at the SMH and bring in a little more data, so we're looking at the last 3 years or so, we can see sort of this, round trip from the peak in the end of 2021, the drop over the next 9 months to make a low in October of last year, just around $83. And you can see we've now gone all the way back up to those previous highs. The real open question, which I'm skeptical of, is whether semiconductors can just blow through to new highs without taking a meaningful break. And arguably a gap lower today, down about 1.2%. Is this the beginning of a further break to the downside? Maybe the ascending 50-day moving average would be a decent downside target. That's around 140 or so, a little below there. What's interesting about the chart of the SMH is you can pull back in semiconductors even further, still be within a pretty reasonable uptrend, and also give yourself a little more breathing room, or at least reset this uptrend. When I talk about a reset, you have to remember that stocks do not do well, ETFs do not do well if they just go vertical, because all of a sudden, anyone that bought that is now sitting on huge paper profits, at some point, taking those profits looks really attractive and locking them in. And enough people do that, that profit taking can cause a reversal that is quite painful and quite sudden. So by having these little drawdowns along the way, that gives you an opportunity to buy in at a higher low. That could be the setup we're seeing here. Again, we're sort of in that seasonally weaker half of the year between May and October. Is this the time to reset on a leading group like semiconductors? I don't think that's an unrealistic expectation. I would certainly be looking at a higher low and an opportunity to regain a position in an area that's been that's certainly been one of the stronger areas of the market. Just talking coffee, a local Seattle company you may not have heard of. They make coffee called Starbucks. You can see we highlighted this chart recently, which is this topping pattern, this sort of basing pattern, right? You made a high in February, made a higher high at the end of April, and then came back and retesting support. In the last week, we've now failed to hold the 200-day moving average. We've actually broken down below that support level. So what also concerns me about this market currently is in a bearish phase, or in the end of a bull market phase, you start to find stocks that break out and fail those breakouts, right? They try to make new highs and they fail. Starbucks at the end of April is probably a good example of that. They pulled back to support, but instead of holding that support level, they break down. That's why the breakdown on a chart like Starbucks, I think, is kind of a rough sign for Starbucks, but also tells you something, maybe the broader health of this market, if buyers are not coming in and willing to bid these prices back higher a little bit. Also want to put out something like, let's see, that's not the right ticker, Generac, GNRC. Same thing, right? Or different pattern, but a similar idea. We talked about Generac getting above its 200-day moving average. That's encouraging. Making a new high for the year, that's encouraging as well. Getting up to 150, but now rotating back lower. Can it hold that breakout level? And at this point, it's kind of a question mark because we pulled back to support. In bullish phases, stocks break out and follow through. When that bullish phase hits an exhaustion point, you start to see stocks unable to hold those breakout levels. That's a concerning development I'm maybe seeing on charts like Starbucks and Generac. Let's take a quick break here. We're going to be back with Bartels of Sanctuary Wealth. Before we bring her on, though, I want to remind you, we're doing a mailbag segment at the end of this week, tomorrow on Friday's show, and we'd love to feature you and one of your questions on the air. You can get your questions to us via email. The final bar at StockCharts.com is the best way to get your questions our way. We're also on the Twitters at FinalBarSCTV. So just tag us in a comment there. We'll make sure we check out your questions. On YouTube, just put a comment right below the video you're watching. We'd love to hear from you. We hope to answer your question on our next mailbag show. That'll be on Friday of this week. I want to bring on today's guest, Bartels. Marianne is the Chief Investment Strategist at Sanctuary Wealth, coming to us from New York. I've known Marianne and known her work certainly for many, many years. She was a chief strategist at Merrill Lynch and then at B of A. Has had a successful career followed by a wide institutional following. Marianne, it is great to see you and welcome to the show.
Oh, thank you, Dave. It's wonderful to see you. And I'm such a huge fan of your program.
You're kind to say it. It was so good to see you in New York at the CMT Symposium. I'm glad we were able to connect, and I'm really happy we were able to make this appearance happen. Very interested to get your take on what's happening. A lot of uncertainty. We're now starting to see maybe some little, nuggets of concern as stocks start to rotate a little bit. We're seeing rates go higher. So I'm very keen to get your take on things. We're going to start with your chart, long-term chart. Let's take a step back, can we, and look at the big picture. What does this long-term chart of the Dow tell you?
Well, Dave, as you know, there's many different trends, and many people forget about the very, very long-term trend. So this is the Dow Jones Industrial Average going all the way back into the 20s. So it's not a chart we generally look at all the time. But I like to use this, particularly with wealth management clients, because I like to set the stage of where we are in the longer-term cycle. Are we in a secular bull market? Are we in a secular bear market? And we've commented that in 2013, when you started hitting new record all-time highs, passing the 2007, that marked a new secular bull market. And secular bull markets can run 15 to 20 years. So we still think that this market has legs over the next 5 to 7 years. So the long term remains very bullish for us.
It's so easy to get caught into the short-term movements. This is a great reminder to sort of think a little more big picture and recognize how long those bull markets can last. That's actually a really good starting point. Your monthly chart of the S&P is really interesting. We were talking about this before the show. Can you talk us through what sort of signals you've seen going through 2022 now into 2023?
Sure. So when we were looking the markets back in December, trying to come up with our outlook for 2023, again, I look at long-term, short-term, intermediate. I try to look at all the trends. And an indicator that's been very good to me throughout the years is the stochastic. And we tend to use that over a 14-day period, but you can also use that monthly and go back over a longer-term period. So in December, when I was working on my longer-term outlook, I looked at the monthly on the stochastic 14-month, and I found that it was the most oversold since 2008 and 2009. And that actually really shocked me. I didn't expect to see that. And that helped us set the outlook for 2023, saying that we thought that we would get the best buying opportunity since 2008 and 2009 in 2023. Now, I'm not trying to pat myself on the back. We have good calls, we have bad calls. The market is extremely humbling. But as you can see, that stochastic did give a buy signal. And now what we're looking at is the MACD on a monthly basis, and we're just getting that buy signal. So I think that's another confirmation that this market, even though, it's been fireworks for the first half of the year, it's not at its end. We still think the second half has room to rally, but it may not be in a straight line.
Yeah, it's worth remembering some of these longer term trends. Obviously, there's a lot of peaks and valleys that kind of go into that. Your daily chart of the S&P really speaks to the current conditions and where we're at. As we look, sort of wrap Q2, we're now looking at the third quarter. What sort of situation do you see for the S&P now?
Well, it's really the same as you explained in the beginning of the program. You pointed out some negative divergences that were happening. I just looked at it from the same price momentum indicators just to be consistent. And we're overbought. And we should be overbought. The markets were up a lot in the first half of the year that you need to consolidate part of these gains. So I think we're in a corrective phase, but it's a phase that refreshes or a pause that refreshes. So we're telling our clients to actually buy on a pullback.
And it's really interesting as we sort of begin July with what we're seeing now with some of these divergences with some of the stocks that have had runs that are starting to be overbought. Do you think this is the beginning of that pullback that you might expect going through July into August, or what's a sense of a timing of how this plays out?
So my sense has been you can get this pullback in July. Markets often actually peak in August, though. So
Mm.
I think we can get a pause that refreshes. I think markets can rally again into August and then have that seasonal pullback into September and October and then have a year-end rally. And remember, we're in the third year of the presidential cycle.
Mm.
That's the best year. And when you have a really good first half, it means that your second half also tends to even be better than normal.
So I have to ask, obviously we're heading into this sort of unusual, unique environment with the Fed. We had a pretty consistent series of rate hikes. We then had a big pause in June. Next Fed meeting coming up in a couple weeks. What are your expectations looking forward, and how does that impact sort of the environment for risk assets?
So it definitely appears that the Fed has not finished its rate cycle, although we're probably coming towards the end of the cycle. It looks like they're going to continue to raise rates, but may do it every other month. So they paused here. Next month, a raise of 25, maybe a pause, and then another raise. So, at least 2 more rate hikes potentially this year. But remember, next year is a presidential year, and very rarely do we have recessions in a presidential election year. So it's going to get a little tricky for the Fed as we come into year end and next year. Now, inflation has been elevated and is above their 2%. But if you look at all the inflation gauges, they're all falling. Maybe not to the level that the Fed wants, but inflation is definitely falling.
Seems like we're making progress in some way. We have the chart of the 10-year up. I'd love to just ask you, I mentioned in the market recap, sort of this interesting environment where we see rates now starting to emerge higher, 10-year yield getting back above 4%, but some of those leading growth stocks continuing to be strong. What do you make of this idea of this sort of, juxtaposition of higher rates but stronger growth? I was taught to expect the opposite. What do you think is going on with that relationship?
We have been in the camp that rates are in a peaking cycle. And, we can go up and test the highs. And as you know, things can make a marginal new high. If you looked at the 10-year actually rallied today and backed off. I'm not a Japanese candlestick expert, but it kind of looked like an upside down hammer where we tried to push through and we actually failed. So this could be possibly a sign that we're still in the peaking process for interest rates, which would explain why the growth stocks remain so strong.
Just to finish off here, Marianne, we were talking about just ideas about where to be positioned, how to sort of navigate this thing. You had one sector you wanted to highlight as a potential idea. Talk to us about industrials and what the setup might be here.
Yes, trying to find something that hasn't moved in terms of a big technical breakout yet, but has a potential to have a big breakout are the S&P industrials. And here we're taking a look at I believe it's the XLI, which is the Spider ETF. And again, looking at long-term momentum, Stochastics already gave a buy. We're just getting a buy on the MACD. I think at some point this year, we're going to break out of this basing pattern, and it's going to be very significant. So I still think that cyclicals are going to do well, and industrials will do well. Industrials will also do well based on the legislation that President Biden signed. He signed the infrastructure bill. He signed the CHIPS Act. He signed the Inflation Protection Act. That's $3 trillion that will hit our economy over the next 3 to 5 years. We think one of the sectors that will benefit from these pieces of legislation are the industrials.
Marianne, this has been so much fun. We only have about a minute left, but I'd love to ask you, because you obviously have had a great career as a strategist. You've often told me off camera or outside of meetings, I'm not a technician, but you certainly speak like one, and you come from a lineage of technical analysts. Can you just talk briefly about how you relate what you're seeing on the charts to what you're seeing elsewhere? Where does it fit into your process?
Well, I can tell you, Dave, the charts never lie. And the charts have been friends of mine since the beginning of my career. I was technically a technician at Merrill Lynch, but I never was formally trained outside of my aunt, who was Bernadette Bartels Murphy. That was a technician. And that's where I honed in the beginning of my skills. And then I was blessed with taking classes with Ralph Alcampora and with John Murphy. John Murphy used to actually teach. So I have been taught technical analysis, but I've had a very varied background between quant and strategy, and I blend it all. But the one thing, Dave, I always look at are the charts.
Marianne, it's so great to see you. Thanks again for coming on the show. I hope we can do it again sometime, but until then, stay safe and be well there in New York.
Thank you so much for having me, Dave.
That's Marianne Bartels. Marianne's the Chief Investment Strategist at Sanctuary Wealth, coming to us from the New York area. And again, her aunt, who she mentioned there at the end, one of the founding members of the Market Technicians Association, a former president, really did so much and was an early female practitioner, paving the way for Marianne and many others to find success in the industry. So a great take there. And I love that. I love that sort of comments about how the charts fit into other disciplines, right? I think we often on this show focus on the charts, focus on technical indicators and signals. What I would always encourage you, sort of what Marianne had suggested, I think it's part of a broader process. Make sure you understand how the charts fit into those other disciplines and how you can relate them. But the charts never lie. I think that's a great quote that I will certainly borrow from Marianne Bartels at Sanctuary Wealth. Great take there. Let's wrap up the show, folks, and go to the 3 and 3, 3 charts in 3 minutes to tell the story of this market environment. Here is chart number 1. I'm going to keep highlighting bearish divergences until we either get a significant top that I can show you that it worked out, or highlight how it was just a false buy or false sell signal. But I continue to see them emerge. We mentioned them on some of the other names over the last couple of weeks. I'm seeing it on Amazon this week as I was scanning for stocks making new swing highs. I'm often looking at the momentum characteristics because price moving higher on stronger momentum, usually pretty encouraging. Prices continue to go higher, but the momentum starts to dissipate, often can indicate that a bull phase is exhausted or near an exhaustion point. I'm starting to see that sort of concerning development on a chart like Amazon. That makes me a little more concerned than I would be normally, telling me that maybe we're at the end of a move here. Now, I think, as our guest Marianne Bartels very, very clearly put, I think there's a big difference between a significant 2000 sort of market top, 2007 sort of top, versus a pullback within an uptrend. I think let's remember that the long-term sort of secular trend still very much in a position of strength, but these signs of divergences often indicate, at the very least, a short-term retracement. I think that's what we're sort of looking at now. Chart number 2 is looking at the TLT. We highlighted interest rates, talked about what a rising rate environment may mean, talked about the relationship between growth stocks and elsewhere. I would highlight the fact that I think you're certainly moving here. We've been talking about this sideways trend for the fixed income space, how we really have been in that third direction of sideways instead of up or down. But I'm starting to see some breakdowns here. If you take a trend line from the March and May lows on the TLT, that's a Treasury bond ETF, you can see today we're actually breaking below that trend line. The RSI is right around 40. That's where you usually bottom out during a consolidation phase or during a bullish phase. You break below that level on a sell-off, and oftentimes that indicates that things are different. I think bond prices are close to breaking down here, and potentially, of course, that would mean rates pushing a little bit higher from where we're at. Finally, great take from Marianne Bartels, mentioned the industrial sector. I have to highlight a cup and handle pattern, one of my favorite patterns to highlight, because what it shows you is after a move higher, you have what's called a rounded bottoming pattern, right? Sort of the upper end, you sort of have this rounded sort of gradual drop and then gradual incline. You retest those previous highs. That's your cup. You have a little handle, which is sort of a shallower pullback. In this case, pulling back to an ascending 50-day moving average this week. We are breaking above the rim of the cup. We're breaking to a new swing high. That cup and handle pattern was really popularized by Bill O'Neill, indicating, sort of a consolidation phase, a basing pattern, and an exit from the basing pattern. As I'm scanning for stocks showing constructive patterns and technical breakouts, I'm finding more and more in the industrial sectors. I think that could be an interesting area to scan for as well. Make sure you're using our scanning engine to find individual names showing constructive technical patterns. Folks, that's a wrap for the show. Thank you so much for joining us every weekday after the close for the final bar. A special thank you to Marianne Bartels from Sanctuary Wealth in New York joining us. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a great night.